What's up guys, my name is Tenbagger. I'm a self-made millionaire investor and I want to leverage my professional fund training to help guys like you become better, smarter investors. In this video, we're going to be covering Tesla. And Tesla's been down about 25% just in the past few weeks or so. So the question is, do you buy the dip? In this video, I'm going to be going over 4 catalysts that I see that could propel the stock higher, but this isn't a generic Tesla bull video. I strongly recommend that you stick towards the very end where I'll give my investment recommendation with an abundance of caution based on market conditions that I'm seeing. So if you want that full picture, I think it would be in your best interest to watch until the end of this video. If you're new to the channel, please consider giving this video a thumbs up and subscribing. Not only does it help support the channel, as I have a larger audience, it allows me to cover names that are potentially more compelling, not just because they have a lot of search volume, and in the end, it's a win-win relationship between you and I. With that out of the way, let's talk about the first catalyst, and that is smashing deliveries out of the park. Now, whenever we talk about Tesla, the most importantly watched metric is deliveries, and deliveries are just constantly being upped because Wall Street gets them wrong all the time. They're always undershooting, and the current consensus estimate according to FactSet is for 1.4 million deliveries for 2022 and 1.8 million for 2023. And mind you, just a month ago or even a few weeks ago, they were at 1.3 million for 2022 and not even 1.6 million for 2023. So you see this constant re-upping of deliveries. Now let me tell you something. Both of these projections are too low, and they're also just flat out wrong. See, with growth companies, if you grow by the same amount in absolute terms, that's actually considered a pretty terrible result. So let's say in 2020, Tesla delivered 500K vehicles, give or take. So going from 2020 to 2021, if you gained plus 400K vehicles to at least 900K in 2021, then how the hell do you explain flatlining from here when, by the way, 2 new gigafactories are coming online in 2022? How do you go from 900K to 1.3 to 1.7? The math just doesn't compute. So there's either some extreme competition going on in the outer, or in this case, not so outer years, or the estimates are just flat out way too conservative. And I strongly suspect that it's a lot of the latter going on, and the analyst estimates are way too low. Let me first give you my take on 2022 before moving on to the outer years. And this is going to be based on a combination of reports, articles, analyst predictions, and my own personal predictions. So in 2022, we know these plants are going to be ramping up production. So year 1 or year 0.5, we're not going to see a ton of production, but it's certainly not zero. For Giga Berlin, in the first half of 2022, this article says that we're going to see about 30,000 vehicles coming out of the factory. Eventually, Elon wants to be able to produce 500K cars run rate, but I think that if we get to 30K the first half, we can probably assume that the second half is going to be a lot more robust. So let's just call it 70K for about 100K out of Giga Berlin. Now, Giga Austin is already producing a lot of cars. You see a lineup of Model Ys outside the factory. I think it's fair to say that we can safely assume a little bit higher than Giga Berlin, about 150K deliveries out of Giga Austin as well. The Shanghai plant, according to this equity research article, is already at a 700K run rate, and we should see another 500K to 600K out of the Fremont plant. So in terms of overall deliveries, I would say that Tesla can get anywhere between 1.45 to 1.6 million deliveries, or an increase of between 500K to 700K from 2021. They can obviously go above this, as this doesn't include the impact of the Cybertruck, the Tesla Semi, or the 25K car, possibly the most important vehicle in the truly entry-level model that I think will be their best-selling car ever, and really put the internal combustion engine to shame and on a path towards extinction. Now, it's worth remembering that Tesla's back-ordered like hell, so we don't have to worry too much about the demand side of the equation as long as production and supply can keep up. Hopefully, this exercise goes to show how 2023 analyst projections are absurdly too low. So if we're adding 500K to 700K, going from 2021 to 2022, how can we go back to adding 400K in the next year? Growth just doesn't work that way at all. The second catalyst I want to talk about is broad valuation support within the EV sector. So when Tesla was starting out, they were being compared to the likes of traditional automakers such as Ford and GM. Now they're being compared to more upstarty EVs, and it's kind of like how Bitcoin is quote unquote cheap compared to some of these altcoins that keep popping up. And as much as people like to think about Tesla as the poster child for stock market excess, especially in the EV domain. I have to say that award more likely goes to Rivian, which was valued north of 100 million right after their IPO, which is way, way above what Tesla was valued when they had all this charging infrastructure and actual deliveries approaching 100,000. Suddenly you have all these guys that have not yet rolled out a product trading at absurd valuations out of the gate. From a relative valuation standpoint, it helps to see a cropping of smaller yet richly valued companies. So if Tesla's the OG at just under $1 trillion, you've got Rivian at 100 billion market cap, Lucid at 62, NIO 55, and Xpeng at 40 billion. The third catalyst is the EV tax credit as part of the Build Back Better plan that's being proposed. And this is $7,500, by the way. It's not going to get to $12.5K because Tesla doesn't really hire union workers, which is part of the deal. But that $7,500 could play one of two ways, both of which end up greatly benefiting the company. They could either use that credit to lower the purchase price of a new Tesla, so let's say going from $50K, which is the average selling price of one of these cars, to about $42.5K, or Tesla could look at its existing order book and say, geez, people are buying the hell out of our products. It's not really professional of us to have 12, month plus wait times. Let's just jack up the price and keep that incremental $7,500 as profit. And by the way, that $7,500 pretty much goes directly to Tesla's bottom line. So if Tesla sells, let's say by a conservative estimate, 1.5 million cars next year, that's an extra 11.25 billion that mostly goes towards their income. I don't have a crystal ball. I don't know if it's even going to get included as part of the BBB bill, but if it does, I'm more inclined towards the latter scenario. But again, both of these scenarios benefit us as potential shareholders. Now, the fourth catalyst is that Elon Musk appears to be almost done selling, and he's selling primarily for tax reasons, but also potentially because he thought the stock valuation was a bit high. And apparently so do a bunch of other corporate insiders this year, such as Microsoft's Satya Nadella to AMC's Adam Aron. And with Elon selling, there's a 1-2 punch of not only the selling itself, which is acute because he owns so many shares and he can flood that into the market, causing a drastic sell-off, but also the mere idea of him selling casting a negative light on the stock itself. But as long as he's almost done selling, which appears he is, we're almost at the end of tax loss harvest season, and he's selling primarily for tax reasons, I'm supportive of the move. Once the selling is behind us, we can remove this as a drag on the shares. Oh boy. Now that gets us to the decision point of today's video, which is, should you buy the dip in Tesla stock after it reached all-time highs? And before I get into that, there's something you should know that's happening in the market, and this is very important. And that is, breadth in the market is absolutely atrocious. Growth stocks, value stocks, cyclical stocks, they're getting shot one by one. We saw this across some of the best performing stocks from the beginning of the pandemic, and we're continuing to see that bloodbath today. And the reason for this has a lot to do with the Fed tapering and their rate hikes coming faster than expected to rein in inflation. See, when the Fed cut rates to zero and injected 120 billion per month of liquidity into the system for 20 straight months, that created a state of nirvana for growth stocks and has created an undeniable pocket of froth in the market. And combine that with the fact that you have a bunch of day traders and new Robin Hooders who have nothing better to do than sit at home and play in the market, and this bubble has gotten larger and larger. And you may think that Tesla's different, that they're too big, they're basically the size of Meta and practically a FANG now, but history, and mind you, I don't have a crystal ball, I'm going off history, especially recent history, shows that this is simply not true. Tesla sank in a pretty big way, along with overall growth stocks back in March. If this market is any indication, where we see breadth declining, where we see massive, inexplicable sell-offs in growth stocks, it will likely do so again. You have to understand that this is not a normal bull market at all. You've got a lot of great companies, and mind you, I own a lot of these companies, right, that have posted excellent earnings, beat and raises, great guidance, beats on revenue, beats on earnings, raise their estimates, and they're still dropping without any rhyme or reason. These are companies like C Limited, Datadog, Snowflake, Mercado Libre, DigitalOcean, CrowdStrike. And this simply doesn't happen in healthy markets. There's really been a lot of concern around growth valuation and excesses. Fundamentals and valuations are being thrown out the window in a very violent fashion. And a lot of this has to do with the Fed. The last thing you want to do is fight the Fed. Historically, we see growth stocks rise and inflate before coming down in an almost perfect, swift, parabolic move, which means these dips that are happening in the market today, while it's tempting at the moment, they potentially signal, and my prediction is they will signal more pain to come. And if history is any indication, they typically happen in the areas of the market that saw the swiftest runs up, irrespective of how strong the fundamentals of the company are. These are your companies like Upstart, Asana, SentinelOne. Basically, the bigger the rip, the harder the trip. Don't be like me. I used to think when I was younger, and I'm still young, but I've been investing for a long time. But back in 2008, I naively thought that the best stocks in the market, the ones with the highest growth prospects, they would be the ones that would be able to ride out this recession, be able to power through. And I learned a very tough lesson, which is I got burned, right? Because in a bear market, all fundamentals go out the window. This applies to all assets, by the way, including cryptos, stocks, and Tesla. Every single market goes through periods of expansion and recession, fear and greed. It's practically unavoidable. So if you look at the market as it stands today, on December 13th, one by one, the majority of the stocks underlying the market, except for maybe the top 10 or 15, which have contributed almost half of the returns of the S&P 500, have been shot. And the market continues to roll over to this day. Historically, these sorts of corrections aren't going to end until the major indices fall by 10 to 20%. And we haven't seen any dents in the index to date. And if you combine that with the fact that there's a major policy shift happening in the backdrop, there's even more reason for this correction to be bigger than the one that we saw earlier this year. Now, there's a chance that the correction might not happen in 2021. We might be saved by the Santa Claus rally. I fail to see how in early 2022 we don't see some form of correction if the Fed executes on its expected playbook. We saw this again happen in 2014, 2018, 2020, and 2021, each of the major software corrections. And it's just not worth it to try to hang on to those. It's not like the index where if the index falls, 10%, these guys will also fall 10%. These guys will fall anywhere between 30 and 60%. It absolutely makes sense to pay attention to where we are in the market cycle and just be a little bit patient if history is any indication. All right, guys, that's it for this one. Enough doom and gloom. I too am very much looking forward to the day where I can buy Tesla confidently and call myself a Tesla bull. If you have any questions, please leave them in the comments below. I'll get back to them. And as always, thanks so much for watching. Nothing is more important than your time, except for maybe your money. And I hope to catch you on the next one. Peace out.